Welcome to The Explainer. Today, we're tearing back the curtain on one of the most fascinating and honestly misunderstood areas of business. We're talking about the illusion of profit. It's incredibly easy to just look at a company's profit and assume it's a simple, straightforward calculation of what they sold minus what they spent. But the surprising reality? A company's profit isn't just about what they sold. It's actually heavily dictated by how they value what they didn't sell.
So, here's the million-dollar question for you. How can boxes of unsold stock, literally just sitting quietly in a warehouse, legally change the profit a company reports to the whole world? I know it sounds like some kind of accounting magic, but it's actually driven by a strict set of rules that can completely make or break a balance sheet. We're going to decode exactly how this works.
Here's our roadmap for today. We'll start with the inventory profit illusion, then cover the strict rules of valuation, tracking, perpetual versus periodic, FIFO versus average cost, and finally, the real-world financial impact.
All right, let's jump right into Section 1, the inventory profit illusion. Okay, so accounting rules basically exist to keep companies from faking their financial health, right? And to really grasp how inventory fits into this puzzle, we have to understand one foundational concept, the matching principle. This rule essentially states that expenses must be recorded in the exact same accounting period as the revenues they help to generate. Think about it for a second. If a business buys a massive amount of inventory this year with plans to sell it over the next 3 years, well, expensing all of that purchase right now would look like a massive loss. It would severely, artificially understate their profit. The matching principle stops that from happening by carrying those unsold goods forward as an asset.
To put this principle into action, accountants use this really specific stepping stone formula. You start with your opening inventory, literally what you had sitting there on day one. You add the purchases you made during the year. Then, and this is absolutely crucial, you subtract your closing inventory, the value of those unsold goods. The final result is your true cost of sales.
Now, what's genuinely fascinating here is how perfectly this balances out the business reality. Let's say you started with 5,000 rupees of opening inventory, and you went out and made 50,000 rupees in purchases. If you just recorded that whole 50,000 as an expense, your profit would be completely crushed. But because you counted your warehouse and found 7,000 rupees of closing inventory left over, you subtract that. Notice how your actual cost of sales is locked in at 48,000 rupees. That unsold 7,000, it becomes an asset on your balance sheet. It's pretty elegant, and it keeps the profit real. But wait a minute, who actually decides what that unsold closing inventory is worth?
Which brings us to Section 2, the strict rules of valuation.
Because, let's be honest, if companies could just make up the value of their unsold goods, they could manipulate their profits entirely. No way regulators let that happen. That's where International Accounting Standard Number 2, or IAS 2, steps in with a very strict rule. Inventory must be valued at the lower of its cost or its net realizable value. Net realizable value, or NRV, is simply your estimated selling price minus whatever it's going to cost you to finish and actually sell the item.
So the huge takeaway here is that you can't just pretend your inventory is worth what you paid for it if the market has already moved on. Take a look at this example with Tech Gadget's Model X smartphone. It cost them 200 rupees to produce, but a shiny new model just launched, so the old Model X can only sell for 180 rupees now. On top of that, it costs 15 rupees to package and sell it. That makes the true NRV 165 rupees. Because that NRV of 165 is lower than the initial cost of 200, IAS 2 forces the company to value the inventory at 165. They literally must take an immediate 35 rupee write-down expense, which directly takes a bite out of their current profit.
And figuring out that initial cost is highly regulated too. Let's say you're manufacturing a table. Only the costs directly tied to bringing the inventory to its present condition make the cut. The wood, the assembly wages, the factory rent, the freight in to get the materials there. Those are included, totaling 130 rupees. But sales commissions, head office admin salaries, or abnormal waste, like a worker spilling a bucket of glue and ruining materials, excluded entirely. Those go straight to the expense column and do absolutely not get hidden away in inventory value.
Moving right along to Section 3, tracking, perpetual versus periodic. So how on earth do companies actually keep an eye on all these moving boxes of inventory to make these calculations? Well, there are two main systems. First, we have the perpetual inventory system. This one is continuous in real time. Think of your local grocery store. Every single time a barcode is scanned, the inventory and the cost of sales update instantly. Then on the flip side is the periodic inventory system. This is much simpler. You wait until the end of the month or the year, do a massive physical stock count, and update everything all at once. A small boutique selling, say, high-value, low-volume items might rely on this method.
Now for Section 4, FIFO versus average cost.
Okay, let's dive into what I consider the real climax of our explainer, the battle of the valuation methods. Because you see, even if you count your inventory perfectly, you still have to assign a price tag to identical items that you bought at totally different prices throughout the year. Let's look at Electro Components Ltd. During January, they had 400 electronic sensors available for sale. They sold 300, leaving exactly 100 unsold at the end of the month. The big problem? Inflation. They bought these identical sensors in batches throughout the month, and the supplier just kept raising the price, from 10 rupees all the way up to 16 rupees. So what are those remaining 100 units actually worth?
Method number 1 is FIFO, first in, first out. This assumes the oldest stuff you bought is sold first. So to value the 100 left over, we just work backwards from the most recent purchases. We take the last 50 units bought on January 25th at 16 rupees and another 50 units from January 20th at 15 rupees. Multiply those out, and FIFO gives us a closing inventory value of 1,550 rupees, meaning it leaves the newest, absolute most expensive inventory sitting right there on the books as an asset. Now let's contrast FIFO with the periodic average cost method, or AVCO for short. Here, we just take the total cost of all 400 units available, which was 5,100 rupees, and divide it by 400 to get a flat weighted average of 12.75 rupees per unit. Apply that 12.75 to the 100 remaining units, and we get an inventory value of 1,275 rupees. Look at that. Just by smoothing out the price fluctuations, our inventory value dropped by almost 300 rupees compared to FIFO.
Which brings us to our final section, Section 5. The real-world financial impact. We are now going to see exactly how these mathematical choices legally manipulate the financial statements. And honestly, this brilliantly illustrates the illusion of profit. Let's assume Electro Components had 7,000 rupees in sales. Look at their reported gross profit. Under FIFO, profit is 3,450. Under periodic AVCO, it drops to 3,175. It is the exact same company. The exact same boxes were sold to the exact same customers. But FIFO reports the highest profit purely because in a period of inflation, it pushes the older, cheaper costs into the cost of sales, leaving the shiny new, expensive costs padding out the balance sheet.
So what does this all mean? Why does this actually matter? Because these choices dictate a company's real-world strategy. Look at this comparison for an economy with rising prices. A CEO wanting to look absolutely fantastic to investors and maybe secure a big bank loan? They are going to love FIFO. It reports higher profits and puffs up total assets. But a business owner who is laser-focused on cash flow might prefer AVCO. By reporting a lower profit, they legitimately, legally lower their taxable income and defer their tax payments.
To summarize the whole shebang, the valuation method a company chooses is definitely not just a dry technical accounting exercise. It is deeply, deeply strategic. A higher closing inventory mathematically forces a lower cost of goods sold, and a lower cost of goods sold mathematically guarantees a higher gross profit. This completely invisible accounting choice directly impacts tax bills, working capital, and exactly how healthy a business looks to the outside world.
So I want to leave you with this provocative little thought. The next time you are reading through the financial statements of a company you want to invest in, or maybe even a competitor you're analyzing, do you actually know how they value their inventory? Because as we've just seen today, without knowing their methods behind the scenes, the profit you are looking at might just be an illusion.